Inflation is climbing. The data all points to that. The Fed is talking about tightening. How far will the Fed have to go in order to bring inflation under control?
Well, that's the big question. And how tight financial conditions get in 2022 will determine how the markets perform and eventually how the economy then responds in terms of growth. But the Fed is way behind the curve, as we all know, and there's no easy choice because the die has been set. And you know, it's pretty well known right now that the Fed today, remarkably, is still behind the curve. It's still easy. Zero rates right now today, still buying for their balance sheet through QE right now today. Inflation's running at 7%, and America's paying the price literally in higher costs. So, you know, the Fed is crossing at this point where they're crossing the Rubicon. And, you know, we remember, you know, deja vu 2018, you know, equities fell from peak to trough 20% as the Fed raised rates and shrank their balance sheet. But that's when inflation wasn't running. Now inflation's running. They have much more to do. So to your question, the balance sheet that they shrunk back then in 18 was to the tune of $500 billion. Today, the balance sheet's 2x that. So in equivalent terms, that's $1 trillion that they'd have to reduce the balance sheet by on a per annum basis from having expanded balance sheet by $1.5 trillion a year. That's a big delta. That's a big swing. And so how far will equity markets fall when Fed funds rates move to 2%? I said 2%, and 2% is 8 rate hikes, not 3 or 4 like what's priced into the market. So I think we know that answer. I think that equity markets are incredibly vulnerable from here. Buy the dip, that was the earlier discussion in your show today. Yeah, it makes sense because the Fed's still easing right now. And I think the first 2 or 3 or 4 tightenings can be absorbed. But it's what happens after that, because what happens after that is really critical. And what I'm referring to is not just a move up in treasuries, but a tightening of credit conditions that may come.
Well, let's talk about those tighter credit conditions. Right now, spreads are still very, very tight. Bruce, at what point do we see the read-through, not just in terms of equity markets and risk assets, but into credit and start to see some cracks appear?
Well, it hasn't happened yet. The high-yield market, high grades holding in very well. I mean, duration, they're lower on the year because of duration, but not because of spreads. High yield, likewise, is 310 basis points off treasuries and hasn't budged all year long, neither leveraged loans. But there's a lot of excess in the marketplace. The excess is with some of the tech companies, particularly the high-flying, high-multiple tech companies, SPACs, venture capital, early-stage biotech. We see a lot of the excesses in the marketplace. The excesses are really not in credit. So we expect with strong earnings this year for credit to maintain its spread. It'll widen because conditions will get that much tighter as the year goes on, forcing it to widen. But on that widening, we think it's a buy because default rates will remain rather good, 1% or less. So I think, what it comes down to is just the printing. People talk about, is it the supply chain? Is there too much demand? Yes, it's both, but it really is the money that the Fed has printed. We've gone from 7 trillion in money supply, M2, to 21 trillion today. And since COVID, up 6 trillion. And the printing of money, this money for nothing policy, the great giveaway that's happened, has a price to pay. Yep. And there's a price to pay with the Fed with credibility, and there's a price to pay with, inflation. And that's what we're paying now. And since
just to back up, sorry, Bruce, finish your thought.
No, it's unfortunate because consumers, are going to bear the brunt, from our senior citizens to working class America, is a big price to pay for food, for housing, for transportation at the pump, and it's due to these excessive policies of how we printed money. Our analyst team was recently studying, doors and windows, because there's a lot of doors and windows that go into the exterior of a home and the interior of a home. Anderson, Pella, that produce these, vinyl windows, these wooden doors, have taken prices up on average from $150 to $250. That's a 60% increase since COVID. They're making 2-3% 2-3 times a year, 10% price increases. And so this is, and it's because material costs are up, shipping costs are up, labor costs are up,
Yep.
and it can pass through these costs.
Bruce, just to back up a little bit, you're talking about potentially 8 hikes. Can the Fed thread the needle? Can the Fed deliver a soft landing? Or do you think we need to start, if we are talking about 8 hikes, a recession?
A recession does come after the Fed raises rates 4 times. You'll see a recession on average, if you look historically at all the recessions that have happened since the Great Depression. You'll see a recession begin about 2 years later. So you're talking about mid-24 if presumably they raise rates, which they will in Q2, beginning March, let's say of this year. And so beginning March, because there's 8 Fed meetings a year, they have one in January, that leaves 7 Fed meetings left for the year. Will they raise rates all 7 meetings? Or raise rates 3 or 4 times, take a pause? But they have to tighten financial conditions to bring inflation down, and that's what they need to do, because right now it's, all that excess savings that we had built up from all the distributions and folks being able to save have all now been vaporized by inflation. Consumers still have savings, but the excess savings that have been built up, has declined. So you look at retail sales, which recently softened. Was it due to Omicron? Well, that's what the press would have you think, but I think it was really due to inflation. People are spending more at the pump, more in housing, more to heat their homes. They have less discretionary money now to spend on retail sales. That's why retail sales were soft at Christmas.
Bruce, in this kind of environment that you're describing, is it one in which there's going to be more opportunities in distress?
I think credit is going to be really strong, because earnings will be up 8 or 10%, and this calendar year. And with that, companies are in good shape. Most of the companies that we track are in good shape. Some can't pass through, the higher costs, but almost all these companies that we're tracking are passing through higher costs. So I think it's not a corporate default rate event that happens now. Save that one for the recession, not for financial conditions. Financial conditions tightening, first round is Treasury rates move up as the Fed buys less for its balance sheet and as they raise rates. The second part of that, as financial conditions tighten, will be wider credit spreads. Those wider credit spreads can be absorbed by the companies because companies are, for the most part, still highly profitable. But it's when a recession hits, when the economy actually turns down. So right now, the economy last year grew at 6%. This year expected to grow at 4%, and might start that way. But we think ends the year growing about 1.5% to 2%. So we're going to see a deceleration of growth due to tighter financial conditions and this higher inflationary rate that stymies the consumer's ability to spend. That's what's going to happen in the next year and how it plays out.
Bruce, there's an expectation over here in Europe that the ECB is going to sit this one out. Significant pushback every time the idea of a rate hike this year is mentioned. What do you think? Did the ECB have the ability to sit this one out, or do you think it's going to be dragged in as inflation ripples across the world?
Yeah, interesting. The 10-year bonds just went from negative to positive, just right around zero, but just touched positive for the first time, I think, since 19 in 3 years. So that's remarkable to see. What's also really interesting to see is their futures contracts in Europe for the ECB are starting, to tick up a little bit and so they're already pricing in one tightening for this year, one tightening for next year. So I think inflation will impact Europe to a lesser degree because they didn't print as much money. And they didn't run up their balance sheet nearly as much as the U.S. Fed did. So that's number one. Number two, they see less wage inflation. But they'll start to see some wage inflation, and I believe they'll have to tighten once or twice just on the margin. But they didn't have the growth that we had here in the U.S. or the excess of monetary policy that we had. So their reaction then will be less.
Bruce, we're talking in Europe and in the U.S. about the prospects of tighter policy. In China, the direction's going the other way. They are easing. How does that affect your world?
Well, not so much. I think a lot of the supply chain will begin to move from China to logistical points that are much closer to the distribution of products and goods. And so we'll start, a lot of the companies that we're speaking to are already moving their supply chain from China to the US and Latin America. That's a longer term move, but it's starting to happen. China's easing is really about the housing market. The US housing market is about 3.5% of our GDP. In China, housing has been, home construction has been 18% of its GDP. So they can't see their housing market decline, and their housing markets decline rather substantially. Evergrande and all the other companies that went way beyond their skis and are in the process of defaulting and restructuring. So that they're in the process of easing to make housing affordable, to allow an easier financial condition for the companies to complete these projects. And the fact that they tightened the year prior gives them the ability to now ease. And so I think China is in a very different place than what's happening in the US.